Shalom, shalom, shalom. Peace and blessings, peace and blessings. There is a lot still going on in the financial markets. I am back on tonight to discuss the most recent developments since I was last on Saturday. I am your host, Karika White. Thank you for joining me on tonight. I'll tell you that I did not want to come on tonight. I was almost dreading it. I must be honest in saying that. Because I don't like the outlook of where we are headed, but God. That's all I can say is but God. I know God has a plan. I know God has a plan for his people. Um, and I know that those who are prepared and those that move and walk in wisdom will survive this thing for sure. But having said that, I will jump right in. I'll jump right in into this discussion about the banking fallout and collapse and failure and all of that good stuff. So when I left you on Saturday, I told you that um, there would likely be a meeting held that would determine the fate of the bank, Silicon Valley Bank. And as it turns out, Sunday evening around 6:30 p.m., there were a number of news outlets, newspapers, and the like that published a statement saying that they were trying to find someone who would buy Silicon Valley Bank in an auction. They also announced that another bank, Signature Bank, was also facing a similar fate as Silicon Valley Bank. So now, up to that point on Sunday, we were facing really three banks that had failed. There was a bank even prior to Silicon Valley Bank that failed as well. So, having said that, what was reported in this particular report is that, or in the news outlets, was that the depositors of Silicon Valley Bank, they were going to be made whole. Interestingly enough, I think it's some number in between 89% to 93% of those depositors at Silicon Valley Bank had money in their accounts in excess of the $250,000 threshold that the FDIC automatically insures for every depositor. And so what that meant was the vast majority of depositors would not have been made whole. However, the feds, in conjunction with the U.S. Treasury, stepped in to make those depositors whole. They made those depositors whole. Now, when you think about the depositors at Silicon Valley Bank, they're not just regular individuals. Silicon Valley Bank was different in that it was a bank for startup businesses. Okay, it was a bank largely for startup businesses. And so, if the feds, I surmise that if the feds and if the U.S. Treasury had not stepped in to help make these depositors whole, these depositors potentially would not have made payroll this week. And so the fallout from Silicon Valley, the fallout from the Feds raising interest rates, the fallout from all of the stimulus and all of the money that was infused and injected into the economy, i.e., the liquidity that was injected into the economy. The fallout from all of that could have potentially been that people would not have gotten paid this week. And so from the Fed's perspective, from the Treasury's perspective, from the government's perspective, it was far better for them to make these depositors whole than to allow this bank to fail and allow these companies not to make payroll. That's one of the things I want you to understand on tonight. Now, I'm being told, or according to my research, some of the businesses that actually banked with Silicon Valley Bank included companies like Roku. I also heard Etsy and some other companies that banked with Silicon Valley Bank. And again, these are those customers, these are their depositors, right, whom they needed to make whole. Okay, so and when I say whole, I mean this is not whole on the magnitude of $1 million or $2. This is whole on the magnitude of billions of dollars. So what the Fed did, this is the Federal Reserve. If you don't know this, the Federal Reserve serves a couple of key purposes, okay? The Federal Reserve is responsible for monetary policy. The Federal Reserve is responsible for monetary policy. That means that they are concerned with price stability, meaning that they want to keep prices relatively stable, and meaning that they want to do all that they can to keep inflation low. Okay. And I'm sure many of you have heard that the Feds want to keep inflation at like 2%. Okay. That's the goal for the Feds. But when they say they're keeping inflation low, that means that they're keeping prices relatively stable, and you don't see these spikes in prices rapidly. As a part of monetary policy, the Feds are also responsible for keeping steady employment, okay? Steady employment. And if you didn't know, over the last couple of weeks, the jobs reports that have been coming out, and jobs reports they tend to be a lagging indicator of the health of the economy, right? But needless to say, the jobless, or I'm sorry, not the jobless, but the jobs report has shown really, really good signs, right? More than what has anticipated in terms of the number of jobs has been added to the economy, okay? And in fact, many people speculate that because so many jobs are being added and because people are making more money in general, that is keeping a demand for certain supplies and goods and services. And so that keeps the inflation going the way that it has been going, although it's eased according to some of the indicators of late. Okay, so the Fed's responsible for monetary policy, and generally that monetary policy wants to keep prices stable, and it wants to keep people employed up to a point. Now, 100% or full employment is not 100% employment, okay, for the Feds. Full employment is not 100% employment for the Feds. Generally, they like to be around, call it 4%. In terms of unemployment, right? But it is not 100% employment when they say they want full employment, okay? In addition to monetary policy, the Fed is called, or the Fed can be thought of as the lender of last resort. So anytime there are issues with the banks, or those types of financial institutions, the Fed will generally be the one that steps in to help infuse liquidity into the system, to help keep the markets and the financial markets going. Okay. So the Fed, now going back to my earlier point about Silicon Valley Bank, the Fed stepped in, said, we're going to make these depositors whole. We want to make sure these depositors make their make their payrolls, right? So the Fed stepped in and said, we're going to do what we need to do to cover um, these depositors, right? So that they can make these folks whole. And so folks won't lose their income as a result of the actions of the banks and of the Federal Reserve. Okay. So I laid the groundwork there. Okay. So what the Federal Reserve did is they said that the banks, right, that are part of the banking system, they set aside, or the banks actually pay into a particular fund every month. Let's call it every month. I'm not sure if it's every month, but the banks pay into a particular fund. Okay. Hey to everyone that's been joining. So the banks pay into this fund. So the Federal Reserve says, hey, we're going to make these depositors at Silicon Valley Bank, as well as the other bank, which is Signature Bank. We're going to make these depositors whole. We're going to tap into this fund that these banks have already been paying into. And that's how we're going to make the depositors whole, by pulling out of that fund. And essentially what they're doing, what the Fed is doing, is that they are lending money to these banks that are on the ragged edge of being what I like to call insolvent. Okay. Much like if, your liabilities on your balance sheet outweighs the assets or the cash that you're bringing in, that means you are insolvent. And so these banks are insolvent. And so what they are doing is that they are borrowing money. These banks that are now insolvent, because of the assets that they are keeping on their balance sheet, they are going to the Feds. They're getting this loan from the Feds to inject liquidity into the bank. Now, I broke down in my video on Saturday exactly what it means about how what shows up on a bank's asset side of its balance sheet and the liability side. So I encourage you to go back to that one. Okay. So the banks that are on the ragged edge of failing, Silicon Valley Bank, this other one, Signature Bank, they've now gotten loans from the Feds to keep their depositors whole and to keep them going. It remains to be seen who ends up with Silicon Valley Bank. We don't know that as of yet. They're talking about auctioning the bank off. I think they've gone to a couple of people to, buy that bank or merge with them, and they haven't made that decision. Okay. The other interesting thing is that the Treasury, the U.S. Treasury now, in order to have what they call a backstop to this banking fund or this banking lending program that the Fed has launched, they have agreed to have a backstop of $25 billion. $25 billion. Now, the Treasury is saying that this is not taxpayers' money, but I have a hard time with that. I really do. Okay, so having said all of that, and I know it was a mouthful, but I wanted to get you up to speed as to where we are. The Federal Reserve and the Federal Reserve Chairman, they've got a tough decision to make. And that tough decision is between now and next week, they have to make a decision on whether or not, given all of this fallout in the banking system, they have to determine whether or not they will raise interest rates. Okay. And I know you're probably thinking, what does that have to do with me? What does that have to do with my finances? What does that have to do with my future going forward? And it has a lot to do with your finances, with the financial outlook of your family and of your future, especially if you're not prepared, especially if you are in any way close to being close to being insolvent. Okay. So the Fed, in my opinion, has three tough decisions, or three choices, if you will, that they have to make in regards to interest rates. Okay. The first would be this: do they raise interest rates? If they decide to raise interest rates, what does that mean? That means that there could be other potential bank fallouts, other bank fallouts, other banks that fail, other banks that are going to need liquidity in their system, other banks that will need to borrow money from the feds in order to stay afloat. That's the first thing. That in and of itself will continue to have an impact on the stock market, as we saw on today. We saw bank stocks, we saw them fall precipitously today. We saw bank index funds fall precipitously today. So if the Feds determine that they're going to hold the line and they're going to continue to raise interest rates in order to kill inflation, we know that there will likely be potentially other bank fallouts, and there will be an impact to the stock market. It will be an impact. Here's the other thing. The other piece is this: the sheer amount of debt that the US, many households, and many businesses are currently holding on to right now cannot sustain high interest rates. So the cost of debt right now is not what the cost of debt looked like a few years ago. On Saturday, I talked about I have an interest rate on my mortgage of 3%. It's now double that right now. Many households cannot sustain that for long periods of time. Car loans right now, 14%. Many folks cannot sustain that level of interest rate or that cost of debt for a long time. So if the Feds hold the line, which they said that they're going to hold the line on increasing interest rates so that they can uh, destroy demand, if you will, many households can't sustain that. We just can't. Okay. And so the constant increase of interest rates will continue to have an impact on the banking system. It will continue to have an impact on the stock market, and it will continue this debt bubble, if you will, because the cost of debt will just be too high for many households. They won't be able to sustain that. Okay. And then for many people, when you look at things like the housing market, if the Fed continues to raise interest rates, sure, prices in some places will go down as a result of that. But in some markets that will continue to be strong, folks will continue to be priced out of assets such as houses. So that's a potential issue too. All of these things, if the Feds hold the line and continue to increase interest rates. Now, let's suppose, and many people don't think that the Feds are going to continue to increase the interest rates. They think that the Feds are either going to do nothing, meaning keeping the interest rates as they are, or that they could potentially lower them. So let's look at the option if they do nothing. If the Fed does nothing and keep the interest rates there, it doesn't mean that there still won't be other bank fallouts. It could be. We still have the issue of debt at this higher interest rate, which is what I think is like close to 5% now. Forgive me that I don't know the number. I didn't write it down. And folks could continue to be priced out of housing. It's just that simple. So it's really not that much of a difference if they raise the interest rates and if they do nothing. But if they raise the interest rates, rest assured that there will be the impact will be accelerated than if they did nothing. Let's look at the third option. The third option would be if the Feds decided to lower interest rates. If they decided to lower interest rates. If they do that, it doesn't mean anything happens with inflation, because what they will end up doing is, by virtue of lowering interest rates, that means that it makes lending and borrowing more attractive, which now adds liquidity to the banking system and to the markets. And so now inflation continues to go up and up and up. The only, call it, benefit, if you will, is that the cost of debt that people are carrying will be cheaper. So that's a benefit. But you still may have the issue where folks are priced out of housing, because now we go back to a housing market where prices continue to go up potentially, and you don't have enough houses on the market for the demand that is there. So none of the options that are before the feds is attractive at all. And I cannot guarantee that they're going to choose the path of least resistance or choose the path of least destruction, if you will. So having said that, what does this mean for you? What is your move now? I'm going to tell you this. We all need to pray. If you weren't praying and fasting, you need to pray and fast like never before. And I typically don't, when I talk about finances, I typically don't talk about praying and fasting. But it's the time now we need to pray and we need to fast, because we need guidance and we need direction from God. We need wisdom from God in this hour. Because like I said, the Fed does not have an easy option. All options that I see right now look bad. They look bad. And so with that, we need to pray and we need to fast. That's step number one. Step number two is you need to reduce your spending now. And when I say reduce spending, I mean reduce spending. I'm not talking about on necessities. Okay. I still want you to, eat well. And when I say eat well, eat healthy. I'm not talking about going out to a restaurant every weekend to eat, but reduce your spending so that you can maximize your cash flow. Okay. In my last video, I said you need to have a stash of cash. I'm going to keep that position. You must have a stash of cash at this point. You don't know which way this thing is going to go. And that stash of cash needs to be outside of the banking system. Okay. So I want you to reduce your spending. Keep spending on the necessities. Okay. I don't want you to forego bills and those types of things, but reduce your spending on frivolous items. All right. I know certain artists are coming out. They've got concerts and different things like that. You don't need to spend on anybody's concert right now. That's not a priority. It's not a priority. So reduce your spending on things like that. Reduce your spending on wants, not needs. That's what you've got to do. Okay. So pray and fast and pray. Reduce your spending. And then next, you got to be careful with debt. Going back to my earlier statement, if the feds decide to increase interest rates, or even if they keep and hold the line, many households cannot sustain high cost of debt. It is just not sustainable. Don't do it if you don't have to. You don't want to have a car note with an interest rate of 14%. That's like putting a car on a credit card. And I know I sound like a broken record, but I would never put a car on a credit card unless I was paying that car off the next day. But even with that, that's dangerous. Don't do it. Okay. But you got to be careful with debt at this point. You have to be careful. Now, if God's telling you to go out there and do it, and I'm not coming in between that, right? But right now, you got to be careful with debt. You got to be careful with your spending. You need to pray and fast. I'm saying all of this to say you need to maximize your cash flow and have that stash of cash outside the system. If you got a nice little hunk of change, I'm going to advise you to buy gold and silver. Why buy gold and silver? Because it carries with it no counterparty risk, meaning that the fallout from the banking system is generally not going to impact that gold and silver. Can I tell you, on Friday, gold cost $1,888 an ounce. When I opened up my phone today to check the price of gold, it was up to $1,922 an ounce. So apparently somebody knows something about gold as a safe asset, as a safe haven for storing the value of your wealth in that gold. So I'm going to advise you to, and again, let me say this, I'm not a financial advisor, but I would suggest, that's a better word, I would suggest that if you're looking for a safe place with no counterparty risk, that's a great way to go. And again, I do it myself, so I'm not telling you anything that I do not do. All right. The next thing I'm going to tell you to do is I'm going to tell you to get yourself a tax advisor. Why am I saying that? Because you're going to need to have a tax strategy, not just for this year. And I know we are quickly approaching tax season, April 15th. And then I'm really speaking to those who've not necessarily filed their taxes yet. But you're going to need to get a tax advisor, and you're going to need to have a tax strategy. Why am I saying that? Because they're going to come and they're going to collect taxes. The next step is they're going to have to raise taxes because they're going to have to raise revenue for all the money that they've used for the banks to bail them out. And who's going to pay for that? Who's going to fund that? The American people. So what do we need to do now? We need to pray and fast, reduce your spending, be careful with debt, maximize your cash flow, keep a stash of cash. If you got a nice little hunk of change, preserve your wealth with instruments such as gold and silver that's going to increase in value. Gold and silver typically are not considered investments, but rather they store value and they help to maintain value. Okay. I see someone wrote here, stores are going to push harder in order to keep people spending money because of the bank fallout. They have to keep they got to keep this thing going, right? They want to keep money flowing in the system. That's what an economy is. That's what currency is intended to do. Currency in and of itself is intended to have a flow with it. And so I know what I'm talking about is not popular. I know what I'm talking about on tonight. It's probably not going to get many views. But I feel that it's important to come on and to continue to highlight what's happening. I started talking to people, this was back in 2021, 2020, about different things that they needed to do as it pertained to their financial position and their financial strategy. And I've been holding the line on that. My position has not changed. The one position that has changed is that I largely got out of the stock market. And I did that a few years ago in order to preserve my wealth, because I could see that this was headed in a direction that I just didn't want to expose my 401k and investable assets into. And so with that, folks, I pray that this message has been a blessing. I pray that I hope to at least bring some insight, if just a little, to those that are interested in what's happening and, what will happen next and where this thing is going next. And if there's any developments that I feel like I need to come on and talk about, I will definitely make sure that I do so. Next Monday, we're going to kick off a new series. We're going to kick off a new series around the kingdom. So hopefully you will join me then. And hopefully my messages will not continue to be talking about bank collapses and the like. But we're going to talk about the kingdom because this system is crying out that it's failing, and God is uh, calling us closer to Him, but also calling for us to know more about His kingdom and to step into a new way of life and a new way of living, which is His kingdom and His government. So until next time, peace to you all, blessings to you all. Join me here next Monday for Dominion Mondays, because Mondays are made for dominion. Peace to you all and blessings. Peace and blessings.